Right. For 8 straight years, the richest man in Britain wasn't a duke, a banker, or a royal. He was a steel trader from Rajasthan who lived behind the gates of the most expensive street in London. He bought his house on Kensington Palace Gardens in 2004 for £57 million from Bernie Ecclestone. The papers called it the Taj Mittal because the marble reportedly came from the same quarry as the Taj Mahal. That same year, his daughter's wedding ran 6 days across France, engagement party at Versailles, ceremony at a chateau, Kylie Minogue on the bill, reported cost around £30 million. At the time, the most expensive wedding ever recorded. From 2005 to 2012, the Sunday Times Rich List put him at number 1, 8 years straight. Nobody has matched that run since. And last November, he left. Now you're not worth £15 billion. So why does this matter to you? Because the rule that reportedly moved him is the exact same rule that now decides what happens to your estate. And it changed for everyone on the same day, the 6th of April 2025. And the trap he's walked into, a 10-year clock that keeps ticking after you leave, is the exact trap waiting for any director who thinks leaving is an off switch. By the end of this, you'll know how the clock works and how long yours would run. If you run a limited company, subscribe. This channel tells you what advisors charge by the hour to explain. One thing first, this is what I do all day, the structuring at CT Private Office, the accounts and compliance at Tax for Pros. Link below if you want to work with me. Now the steel man, Lakshmi Mittal, moved his family to London in 1995 and built ArcelorMittal into, for years, the biggest steel maker on earth. It's second now, behind China's state-owned Baowu. But for most of his London life, he was the industry. And he didn't just live here. He was woven in. The house from Ecclestone, around a fifth of Queen's Park Rangers, bought with his family in 2007. Even a run-in with Downing Street in 2002, when a £125,000 donation to Labour and a helpful letter from Tony Blair to Romania made a week of very awkward headlines. 30 years. The rich list these days puts him around £15 billion. So when a man that embedded packs up, it isn't a lifestyle choice. Something in the numbers moved. It came in 2 beats. In March 2025, the Financial Times reported he was planning to go after the non-dom regime was abolished. Sources close to him, no statement from the man himself. Then in November 2025, the Sunday Times reported it as done. Swiss tax resident with serious time and serious property in Dubai, including a reported £78 million mansion on Emirates Hills. Forbes now simply lists his residence as Switzerland, and the reported reason, according to the people around him, was one tax, not income tax, inheritance tax on his worldwide assets. He's never said it publicly himself, so I'll give it to you as it is, reported, not confirmed. But the timing speaks. The rule changed in April 2025, and by November he was gone. So honest question, straight into the comments before we get to the mechanics. He looked at the new rules and left. Would you? Comment, stay or go. Here's what actually changed, and it applies to you as much as to him. On the 6th of April 2025, domicile died. Inheritance tax stopped caring where you're from and started caring only where you live. The test is brutally simple. UK resident for 10 of the last 20 tax years, and you're what the law calls a long-term resident. Your entire worldwide estate sits in the 40% net. Every house, every share, every account on any continent. And here's the bit the headlines missed, and the bit that makes this story genuinely extraordinary. Leaving doesn't switch it off. When a long-term resident leaves, the law follows them out the door with a tail, 3 years minimum, and it scales with how long you lived here, up to the maximum, 10 full tax years for anyone who was resident 20 years or more. He was here 30. So his worldwide estate stays inside UK inheritance tax until roughly 2035. He's 76 years old. Run the arithmetic on that. He hasn't escaped the tax. He started a clock, and he has to outlive it. On the Sunday Times number, 40% of 15 billion is over £6 billion on paper before exemptions, before reliefs, before whatever planning a man with his family office actually has in place. Nobody outside that office knows the real figure. But you don't restructure your entire life at 76 over a rounding error. And one more thing, the law keeps regardless. UK assets never leave the net. The Kensington Palace Gardens houses stay inside UK inheritance tax forever. Tail or no tail, wherever he lives. Now bring it down from 15 billion, because the law genuinely doesn't care about the number. If you've been UK resident 10 of the last 20 tax years, you're a long-term resident too. Same test as him. Your worldwide estate, the company, the house, the pension from 2027, all of it sits in the same 40% net above your allowances. And if you leave, your own tail runs on the same sliding scale. 3 years if you've been here 10 to 13, 1 more year for every year after that, 10 if you've been here 20. And the clocks are the real trap, because there are 2 and they don't line up. Capital gains once you non-resident when a sale completes and gone for more than 5 years, or the gain clause back the year you return. Inheritance tax runs its own separate tail for up to 10. And from April 2027, a UK pension joins your estate and stays in the UK net even after the tail ends, because the scheme itself lives here. Anyone who tells you leaving is one clean move is selling something. If you're genuinely weighing this up, I've put the whole sequence in one place. The exit playbook is 37 quid, both clocks, the day counts, the order to do it in, link below, one last catch before the wrap. Genuinely non-resident is a hard test with a day count, and ties drag you back. Keep a home here, family here, work here, and you can be capped at as few as 16 days a year in the UK before you're resident again. You can afford to live behind that line properly. Most people planning this from a spare bedroom can't, so here's where it lands. The man who defined rich Britain for a decade looked at the new rules and decided Britain wasn't worth 40% of everything he owns, everywhere on earth. That's reported, and the rules he's racing survived a budget, a spring statement, and a change of Prime Minister since. They're not softening, they're the system now. And the system is the same for him as for you. 10 of 20 puts you in. Leaving starts a clock, it doesn't cancel the bill. The only difference between you and him is that he read the rules early and moved while the move-in was worth it. Whether you stay or go, the losing move is doing either one by accident. 2 ways to work with me, both linked below. If there's real money on the line and you want the structure and conversation, that's CT Private Office, apply for a call. And if you want your company run properly every month, the accounts, the payroll, the filings, that's the Tax for Pros packages page, flat monthly price. Pick the one that fits. If this told you something your accountant never has, subscribe. There's one of these every week. Like if it earned it, and hit the hype button under the video in the YouTube app. It costs you nothing, and it pushes this to more people who need it. And tell me below, stay or go. Thanks for watching. Every like, comment, hype and subscribe genuinely helps us keep making these, and it costs you nothing.